So, bottom line, you are your biggest asset. You need to protect your asset, that is you. You need to protect the income that you are bringing in, and you have to protect your massive wealth ability that you have, that you are bringing in.
Are you frustrated watching your hard-earned money ride the knee-jerking Wall Street roller coaster? Are you looking to diversify into alternate investments and set them on autopilot to achieve financial freedom? It's time to learn the ways of the wealthy. It's time to think outside the stocks with your host, Madhvi Jain, an immigrant from India and ex-IT professional who will bring you industry experts to illustrate a passive and holistic financial approach to build not just passive income, but also your generational wealth. Madhvi is on a mission to change the financial trajectory of one family at a time and 1,000 more to go. Are you going to be part of this vision? And now, without further ado, here is the host of Think Outside the Stocks, Madhvi Jain.
Hey, welcome back to Think Outside the Stocks, another episode with your host Madhvi Jain. And today we are actually going to take a little bit different path than just the passive income. We have been talking about creating your completely passive income with real estate syndication, and our focus has been on real estate syndication. But today we are going to be talking about something different. We are going to talk about a problem you didn't know that you have. Yes, that's correct. We are going to talk about actually making your savings efficient, creating that emergency bucket for you more efficient, that lazy money more efficient for you, and also utilizing that parked position of your money in a very, very efficient manner. But before we go ahead, please note that this podcast is information and education purpose only. We are not the legal, tax, or investment advisors. So if you need to seek that help, please do so. So let's jump right in. But before we go ahead, I'd like to thank you for listening, for tuning in all the episodes that we have provided as education opportunity for you. You have been a very diligent listener, a very diligent student of learning with me of all these different aspects of passive income and passive income generation, right? So I'm so grateful that you are with me on this journey so far. And from here on, we are going to talk about that holistic perspective that we talked in episode 1, the holistic perspective, not just focused on passive income and financial freedom, but it's also about growing, preserving, protecting, and passing your generational wealth. And today's topic, the infinity banking system, is going to be focused on this holistic approach. So, are you ready for it? Let's try to understand the problem you didn't know that you had. First of all, you had been hearing about these options of completely passive income in commercial real estate. You had been being excited about it, but what is the problem today? Why haven't you been able to pull that plug and jump into it? Well, in today's market, we have 3 problems, and we have been talking about it through our different guests about this trifecta. Yes, the trifecta about the high interest, high inflation, and the recession. And with this trifecta, you are so limited with your choice. There is so much fear in your mind that you are sitting on the sideline. And when you're sitting on the sideline, whether your money is in high interest earning money market accounts, about 5% or so, it's still losing it to inflation. So you have negative growth year after year by sitting on the sideline, and this inflation is eroding your money away. So that is your one of the biggest problem. The taxes, we have been talking about taxes, that how the interest in this account that is impacting your taxes. There is an interest being earned, but this is your actually active income. This gets taxed at the highest bracket. So even if you are earning that 5%, it's getting taxed at that highest percent. And if you have other vehicles of putting the money, the tax-free buckets, the tax-deferred buckets, these are the 401k plans, your retirement plans, even maybe your education, your IRA, stuff like that. You have a limitation on how much you can contribute to it. There's only so much can go into it. And you also have a limitation on when you can access this money and how you can access this money. If it is retirement perspective, you can access only via retirement age, and during that time to create that income. If it is a tied to educational purpose, you're going to tie it to education, and you can access it penalty free only for the education. So let's understand, why are we talking about this problem? When we have the growing concern of bank failures going on right now, your money that's sitting in your savings account, which is typically your either emergency fund, the money that I call it a sleep well money, which is focused on if you have a job loss, if you have, say, medical health condition, that your family is protected in terms of your expenses, in terms of mortgage, your expenses. You have this cushion of, say, 3 to 6 months. Everybody's different. So you have that cushion that you have been saving in there. If you have a business, if you have a rental real estate, this is your cushion. This is your emergency fund that is going to support your business. And if you have actually investing tendency and you sit out of the market, this is the fund, which is the parked money that sits outside, waiting for a good investment, waiting for that good timing to jump in. Let's understand what is your income potential, what is the actual value of your human life. This is very critical component of understanding the infinite banking concept. Unless you understand what is the value that you bring into the table, you cannot understand the banking concept and why you should implement it. So let's talk about the potential that you bring in. If we think about a person, average age 40, and the retirement age is 65, and current income 150K with 100K in his, say, investing account, which is growing, say, modestly about 6% compounded year after year, and he can add only 6% of his income that he's earning to this savings account every year. With that, at the age 65, this person has a potential for income to bring into the table around $5 million. Yes, you heard it right. It's about $5 million potential of income coming through this 25 years. That is your income potential. But wait, your wealth potential is even more. When you consider that investing that you are doing, and it is coming at 6% compounded interest where you started at 100K, and if you have been adding 6% of your income as savings year after year, that total wealth potential for you, my friend, is about $10 million. This is your true potential. This is your true human value that you are bringing to the table. So bottom line, you are your biggest asset. You need to protect your asset, that is you. You need to protect the income that you are bringing in, and you have to protect your massive wealth ability that you have, that you are bringing in. So if you think about the river of money that flows through your system, can be considered as, like a pipeline, like maybe from a tank, right? So if you have this huge income potential of 5 million, 10 million wealth potential, it is a water tank. There is a pipe attached to it. Imagine that. And you have every year, only some income that's coming through that pipe. Now there is the first filter gets applied, which is the tax filter. And then more money gets spent into your standard of living, your lifestyle, your expenses, your mortgages, etc. Now from that tank, that pipeline, every year, imagine that you push some money up. Now this money goes into two buckets. One, say on the right hand side, is your savings bucket, where is your emergency money sitting in. And the left hand side, imagine that it is the investing bucket, that is your investing money, your playground, where you can take a little bit risk and you can play a little bit, right? The right hand side, the emergency money, this is your foundational wealth. This is your money that you need for your emergencies. This tank should have a tight lid on it. There should not be any evaporation happening. No risk of the money should be happening from this tank. And for the lack of the better vehicle, we tend to keep this money in FDIC insured banks. Now we will talk about that problem a little bit later, but that's what the tendency is. On the left hand side, the investing is happening. There is, of course, some taxes are being leakaged as well, but there is, from time to time, you take that risk and there is some evaporation happening in there. So imagine that. Now let's talk about when we have this massive wealth potential, and this generation as a the foundation of this generation that you are creating this massive wealth. This is the time that you are building your wealth. Your generations are going to add to it what you have started to build. And most of you have built things from scratch. And I'm so proud of that. This generation, what they have built. It's just incredible amount of wealth that's being built right now. So far we talked about the problem of the trifecta, and we also looked at the flow of the money, the river of the money through this tank. Let's continue understanding the problems that we have, because unless we understand the problem, we will not understand the solution to the problem. As Bono says, we thought we had the answers, but it was the questions that we had wrong. So let's ask the right questions to get to that solution. Let's continue finding the problems that we have. Let's talk about the second problem, the wealth destroyer, which is the family. To consider this, we have to go back and look at the history a little bit. In this country, we had our financial fathers that we learned a lot from. We learned what to do from them, and we also learned what to not. Let's look back at 3 influential figures in this country who worked really, really hard in their generation. They started creating this humongous generational wealth. And let's look at about 6th, 7th generation, what is their wealth doing in this country? So, for example, Cornelius Vanderbilt, great example. When he passed away, he passed about $200 million. That's in today's dollars, about 1.4 billion. The 7th generation, the heirs that we see here, the known heir, one name comes to the surface, Anderson Cooper. Now, many of us know Anderson Cooper. He's a self-made millionaire for sure. But it's interesting to understand how much money did he inherited from the inheritance from the Vanderbilt family. It was merely 1.5 million. Now, 1.5 million is still a lot of money, but when you consider the family generational wealth passed along generation after generation, it is not a great sum of money. So what happened to the rest of the wealth? It just got destroyed. Let's look at Andrew Carnegie. Andrew Carnegie had a completely different philosophy. His philosophy was pioneered from the philanthropy. He had about $300 million, about $4.82 billion in today's wealth that he passed when he passed away. But his focus was philanthropy. They focused a lot on building libraries, building schools, and giving away a lot of money. But they gave away from right where the money was created. So they gave away the money. It is a great effort that what he has done for this country, and I have tremendous respect for it. But let's look at the Rockefeller family and how did they do in the past, and what is their nth generation, their 7th generation is doing now. John D. Rockefeller, when he built his empire, he passed around $460 million. That's about $9 billion in today's wealth. His 150 heirs today, they have been using this generational wealth concept that he created and later on used and being added generation after generation, and they have grown this wealth to $11 billion. That's just the known wealth part of it. They might have, some other LLCs and stuff that they have kind of created a structure which we cannot really go and count that money. But what's interesting is that every generation passes, this wealth just increases, right? There's like a massive wealth creation, building, and creating that massive wealth kind of a push at the end of a generation. They also contribute multi-million dollar in the charity from the cash flow. So the heirs get the cash flow, the heirs get, they use this infinite banking system, and we'll talk about that. But they do get the use of generational wealth in a very structured manner. And now when I'm talking to you, why are these things important for you? Because you, my friend, you have started creating the generational wealth for your family. Most of you have built the wealth from scratch. When you are listening to this episode, you know that you have built that wealth from scratch, and this is the foundational of your generational wealth. From here, based on what tools, techniques, and structure that you put in place, your next generation is going to get benefit from it, or otherwise, on the contrary, get a chance to destroy this wealth. So let's talk about what worked well for the financial fathers and what did not work well, right? First of all, family threats. When you have generational wealth, It gets divided, say, into 3 years or 2 years after that generation pass, and then multiplied by 2, multiplied by 2, multiplied by 2. When this wealth gets distributed and disintegrated, what happens is that some are not going to take it seriously. They're going to splurge away this money. Some actually are going to get impacted by either lawsuits, by maybe divorces, or maybe some mental instability, that they are not going to able to grow this wealth. There is a financial ignorance. What happens is when there is a life experience, structure, tools and techniques that one person, one generation learns, and that's, by the way, is you know a lot about your family structure, your experiences, how you have grown and built this wealth. When that one person just knows and he passes away, all the life experience are going to go away. All the structures, the tools, they are going to go away. So the lessons learned is that don't do it. Right? Don't give the next generation a chance to destroy your wealth, from the family threads. And also don't leave them without that proper structure so they can get destroyed. The wealth can get destroyed, right? So what is it that the Rockefeller's family did well that we would like to learn from? First of all, no division, one structure. With their estate planning, with their trust that they created one structure, and only the cash flow is getting distributed to the next generation. It's not the essential, the core wealth. That's not getting divided. That's not getting distributed. They created the tools on tech and techniques in terms of how they are creating the structure of the infinite banking, how they are, investing in different vehicles. What is that percentage that they are going to, invest in different vehicles? And with that, they're protecting and preserving like a family vault. Every time there is new system that they learn, that new system gets added to that generational wealth strategy. And that's how, my friends, they are passing this generational wealth, and massive increase of generational wealth is happening through this inheritance of not just the money, but the inheritance of structures, tools and techniques and the experiences that they have had. Let's talk about our next problem. What is another wealth destroyer? The taxes. We talked about how rich pay the taxes and how, especially the W-2 employees, they pay the taxes, right? When they are paying the taxes in 30 to 40,000 bucket, the wealthy are, say, paying 0 to nothing taxes on the income they are earning because they are creating a lot of tax strategies. Let's take a case study. If you were able to create 50,000 additional income per year, long way to go. I know it's difficult, but it can be possible, right? And you are considering 3 brackets, 0% on that just extra income. I'm not even talking about your W-2 income. I'm talking about just that additional income that you are making. 0%, 15% or 25%. Say if you get a compounded growth of 7% year after year for just about 10 years, in that 10 years, the range between what you are getting, what the growth that you have achieved on this money, it's going to range from about 594,000 to about 794,000. That's a gap of 200K. So the money that you're losing on taxes is not just the money that's going out of your pocket. It's not just that 5,000, 10,000 extra that you're paying, but it is that harnessing the growth of that leakages, what that money can in future make the money from the money that you're losing. If we consider that, in this example, it's about 200K difference. And that's why I want you to focus on avoiding that tax leakages. And when we are providing you this tax efficient investment strategies, that's really, really important to know that at least the money that's coming in, that should have some tax strategy in place for you. Let's talk about our next problem. The qualified plan, which is the retirement plan, either IRAs or the 401ks, even the educational plan where you're putting the money and it's growing, and when you are, it's going tax free. When you're going to take it out, if it is for a particular purpose, for educational purpose, maybe you will not have taxes, but if it is retirement purpose, you're paying deferred taxes. Now the tax free versus tax deferred is a very interesting concept, right? Say for example, if you contributed to your retirement account about 500K, and I'm just keeping it simple, right? 500K that you contributed, You saved, say, minimal taxes, say about 22% taxes, which is about 110K in taxes. Say if that money grows from 500K to $1 million by the time you retire, and now you have the same 22% tax bracket. Now, typically people say that, hey, my tax bracket is higher right now, and when I retire, I'm going to have a lower tax bracket. Is it really going to work like that? The cost of living, the inflation is increasing. When you are able to spend 100K and if you are managing your expenses, when you retire, so 20 years down the line or 10 years down the line, the inflation is going to require you to take at least 150, 200K out, which is equivalent to maybe the salary that you're earning today. So your tax bracket is not going to be different. So in the same example, let's just assume that it's just still 22%. So what you avoided paying taxes on is about $110,000. That's the total tax savings that you had. Now the taxes that you're going to pay is $220,000. That's twice much the taxes. But wait, what about the tax brackets? Are you sure that it's going to be about 22%? If you look at the history of the marginal tax rate for the highest and the lowest wage earners in this country, if you go back and look at it, like say in 1920 or something, the highest tax bracket was close to 80%. In 1960s, that was even higher, close to 90%. Then it started coming down. Not too long ago, about in 1980, it was close to 70%. It has been a little bit lower and it has been consistent over the last few years. But based on the administration, this has a capability of changing. Can you time your retirement age and when you start pulling out that money, what that tax bracket is going to be? So number one, not only you're going to pay higher taxes, but you don't even know what tax bracket it is going to be. It's almost like somebody's giving you a loan and they say that, okay, you can return the money whenever you want, but at the interest rate that I'm going to ask you at that time. That's exactly how it is, because you don't know what your tax liability is going to be, what your tax bracket is going to be when you retire. And if you have any money left over in there, so for example, if you have $1 million left in there, with the Secure Act, now your heirs have to take that money out within 10 years. So imagine if your heirs, your generation, next generation is at, 30, 40 or, 45 age, where that's their peak of earning age. And they have to start taking this almost 100K, 200K out from your retirement account. How much money are they going to pay in the taxes? So the lifetime that you are creating, when you are creating this immaculate strategies of saving your money, investing and, reducing the taxes, that same money is going to face the light of taxes in a very, very heavy manner when it's time to take out the money, or is it time for the heirs to take out that money? So to summarize, as per Bono said, right, it's the questions that we have to ask right. And that's when we have the right answers. And our answers to summarize the problem is number one, the generational wealth depletion. When you are building your wealth right now, you need to put a right structure in place so you can create that generational wealth, which is not getting destroyed. The tax leakages that you have, which hampers your growth of current and the future potential that money can have. The lower interest environment that the banks are providing you, which is very volatile, by the way. It was 1% sometime back. It's 5% right now. But it is also being taxed. So that is the problem. The volatility of bank itself is a big problem. We have so much of problems, so much of, articles, news is coming out of the SVB or the likes of the banks that they're failing. So the banking institutions, there has been several times in history that the banks have failed and Feds had to rush to save these banks. So I question you, that is your money that you are putting on the sideline is safe in the banks? Is it really safe in the bank? Another restrictions that you have on the tax-free or the tax-deferred accounts is there is a limitation on how much you contribute, what purpose you can contribute, and limitation on how much you can take back. And you can take it out based on the number, the age or the education that purpose that you have, right? On top of it, this does not provide any asset protection for you. There is absolutely zero asset protection. So if somebody puts you in a legal hassle or have a lawsuit against you, the money that's sitting in the savings account, that's easy accessible. The money that's sitting in your brokerage account or your rental real estate, all these things, all these assets that you are creating, that is having no asset protection at all. Which, by the way, infinite banking system, we will talk about that it is providing you that asset protection. And on top of it, when you are saving this money in these bank accounts, are they providing you any additional benefits? This is why we need to realign and look at the solution, which is the infinite banking system. Now, when we keep on saying the banking, right? Why am I insisting of you to start thinking like a bank? Let's talk about that a little bit. Let's explain the business of the banks. The bank, when you deposit, say, $1,000 into the bank and they give you right now 5%, sometime back it was 1%. If they give you that $50 in interest, now FDIC permits them to leverage 1:4. In simple terms, what does it mean? It means that now they can give 4 people that $1,000 as a leverage. They do not have to hold all that money into the banks. So now the banks can charge the interest rate anything between, say, 8 to 12%. So they are giving you 5%. They are taking about 12%. That's almost 700% profit. And they can use that money 4 times to create that much profit. And that's the reason why you should think like a bank, so you can harness that power of leverage and still grow your money. That's the reason you should think about the infinite banking strategy. So understanding the need. What is the problem? Focus on investing. You have insufficient savings and you have created that portfolio imbalance. The need is to protect that savings, that parked growth of the money, provide an inflation and tax hedge to it, and create that solid foundation for you. With infinity banking, it's not only creating that efficient savings, that's just one part of it. It is also creating an and asset for you, essentially be able to look at this compounding growth in the banking structure that you are creating, but use the same dollar at 2 different places. And it's called and asset for a reason, that you can use the same dollar and invest in somewhere else. And it is building you a generational wealth. And to be your bank, this is why it's really, really important. In part 2 of understanding the infinite banking strategy, I will continue with some basics and also the structure of this banking system that you need to understand and you need to know so that you can implement it in your own structure. It is important to understand that, and I will continue that in part 2. The part 2 is available for you right around the corner. So let's just jump in and start talking about the basic and the structure of the infinite banking system. Again, thank you so much for listening to another episode with Think Outside the Stocks. I will continue on the other part of this banking system. Thank you for tuning in again and listening to this episode. If you are curious about the infinite banking strategy and just want to learn if this is the right fit for you, please schedule a call with me, just a 15-minute quick call, and you will get to know more about this. And you can do that by going to bit.ly/callthink, just one word, lowercase. So bit.ly/callthink and jump on a call with me and talk about if this is even a right strategy for you. Thank you for tuning in again.
Thanks for tuning in to the Think Outside the Stocks podcast. If you enjoyed today's episode, please like and subscribe. Madhvi is on a mission to change the financial trajectory of one family at a time with 1,000 more to go. We hope you'll be a part of this vision. Please join our growing community, and to get your journey started, visit thinkoutsidethestocks.com to download your free guide on active income with passive real estate investments. If you learned something new, please share it with one person today. And if you have 60 seconds, please leave us an Apple review to help us reach more people like you. Tune in for the next episode.